Welcome to the program. Today we'll talk about whether Wall Street has taught Trump a lesson. We'll get a look at earnings season and we'll discuss how we're investing right now. I'm Peter Switzer.
I'm Peter Switzer.
And we're mad about money. Pete, our colleague Paul Rickard is still living it up overseas, but we're here holding up the fort. First question.
He's the biggest holiday maker in this country, that Rickard.
He gets a lot of holidays in, doesn't he?
We're going to change things.
But he will be watching this, so he'll probably hear that.
Yeah, that's true. Sorry, Paul.
First question, bit of a market pullback post Trump. You know, he's getting, there's a lot of executive orders happening. A lot of people are getting upset. The market has reacted accordingly. We've talked about pullbacks. Your thoughts?
Yeah, okay. So we expected a pullback, not because of Trump making mistakes, just that the rally was so strong. You know, the Russell 2000, which is a small cap index in the US, even with a bit of a pullback since the inauguration, is up 13%. You know, in what? November, December, 3 months. You know, that's extraordinary. And so, in terms of the history of stock markets, a pullback was on the cards. What's happened with the immigration ban, the reaction has been, this guy hasn't done it really well. It was the process that was probably the biggest problem. Apart from the fact that it's pretty offensive for Muslims out there, the prospect of a ban. But the process worried Wall Street, and the next real big question is protection. Will he have an incompetent or an unprofessional approach to trade, and that's starting to worry Wall Street. And I do think this is Wall Street saying to Trump, not directly, indirectly. Directly, they're just taking their profit because they don't know what's going to happen. But I think the indirect lesson is you have to lift your game, or else we will sell off because we're scared.
Trump is a businessman, though, so do you think he'll handle business affairs differently to the way he'd handle more sort of political affairs?
Really sensible businessmen would actually respond. Donald is a really unusual businessman. I'm not saying he's incompetent. He has some great achievements. But he could respond first up with, I'm not going to be told what to do. But I do believe that over time his advisors and the Republican Party and ultimately Congress and Democrats will make him come up with better decisions. So, but we could suffer. February's often a bad month for stocks.
Interestingly, Paul Ryan, Speaker of the House, did get behind him today on his immigration policy. Yes. So obviously an issue that will be rolling out. Earnings season is not far away.
Yep.
Your outlook, Pete, on what you think is going to happen for companies, it should be looking pretty positive with what's happened with mining and energy stocks.
Yeah, the feeling is this is going to be the first reporting season where companies are back in the profits. Part of the reason is resources have done really well, and that's why BHP has gone from $14 to higher, around $27. Big turnaround. So we expect to see some good things in their profits. The interesting story, I think, is the likes of UBS and Citi have put out their predictions for this year, and they think earnings are going to go up by 18% for UBS, 17% for Citi. And Citi actually says that they believe resources companies will be up about 80% in their earnings, but they were clobbered in the last 2 years.
If you look at the last two earnings seasons, if you take out resources, we were up.
Correct. And so non-resources are expected to go up by about 5%. Some interesting...
sort of what they did, was about what they did the last couple of years.
Yeah, and one interesting observation is that they got retail doing well, despite the fact that retail, I think, has been struggling. They got a reasonable outlook, a 10% improvement in earnings for retailers. It's going to be certain stores, I think, and I think stores with good online offerings will probably do pretty well. JB Hi-Fi will do well.
In terms of investing at the moment, 2017, we've obviously launched the Switzer Dividend Growth Fund, which aims to provide reliable franked income streams and long-term capital growth by investing in a core portfolio of Australian shares, really focused on dividend, focused on getting growth, something that we believe will become, a core part of our portfolio.
And that's the way we invest as a family and for our clients. Yeah. We like them to have a strong exposure to dividends because when markets go off the boil, and they do, we know capital loss happens probably 2 years out of 10. We like to think that there's still going to be a stream of income, and so I think having all of us should be thinking about having that kind of core strategy, unless you are a real punter. And if you're a punter, you're a trader, you're a speculator, you're not an investor. So investors should have a strong exposure to dividends. But I like the idea of having maybe 10% exposed to companies that have been unfairly beaten up. CSL was a classic case. As all the big fund managers chased the miners and the banks, good companies that the fund managers have made money out of, like CSL, probably Domino's, all those Icentia, those sort of companies were dumped. And now I think some people should be going back to look at these companies and think, is there good value there? Have they been overbeaten up? There's nothing wrong with it.
So you're thinking, of course, satellite approach, 80 to 90 in reliable, income producing, whether it be stocks or products.
Quality assets.
Quality assets that give you that income with some growth as well. 80 to 90%. And then 10% or
to try
20%, to try to pick a bit more stock selection is sort of what you'll be doing in the year ahead.
Yeah, and I'm not saying, for example, I mentioned Icentia, it was a company that was very good and went down. I'm not saying that's necessarily a buy, but your job should be to pick through those companies that really have potential. And a lot of the experts that I talk about say, I'm looking for good industrial companies that maybe were dumped when fund managers went chasing the resources stocks because they were underexposed to it.
Very important to obviously get advice as well and make sure that you're diversified and you understand what your goals and objectives are and your attitude towards risk. So advice is very important. Yeah. If you want to invest, go to switzer.com.au/invest or give us a call at any time. We're conducting an IPO process. It's currently open and it closes on Friday, February 17. I'm Marty Switzer.
I'm Peter Switzer.
And we're mad about money.